2026 has been a crazy year for the stock market, mainly due to the massive rotation out of the big seven, out of big tech, into boring stocks like Coca-Cola and McDonald's and many others. It's been frustrating for many investors as the Magnificent Seven are down 6.5% year to date on average versus the S&P, which is actually flat. And the rotation has been so extreme that the defensive stocks like the consumer staples have reached a forward PE of 23 times earnings. And those are companies with little to no growth, very low margins, yet they reach 23 times earnings. And Walmart is more expensive than Amazon. Absolutely crazy. And many people are frustrated. Now, in this video, I'm going to explain why this rotation has happened and what will likely cause it to reverse. I believe it could potentially reverse as soon as the second half of 2026. And I'm going to tell you why, and I'm going to tell you how I'm betting on it. Now, the main reason for this whole rotation is the nomination of Kevin Warsh. Kevin Warsh is well known for being pro-rate cuts, so he actually wants lower interest rates, but he's against QE, which is quantitative easings. Now, QE is like the engine of the stock market, I would call it, as the stock market is very much correlated to QE or the Fed balance sheet. Whenever the Fed's balance sheet expands, we recover out of COVID and just amazing recoveries. But once it starts contracting, we started to go down in 2022. And this is how it has always been. When the balance sheet expands, assets do well, especially risk-on assets or assets that are unprofitable or big tech in general. But once the balance sheet contracts, which is what Kevin Warsh wants to do, or this is what market participants believe he's going to do, that's really bad for tech stocks and risk assets. It's bad for Bitcoin. Bitcoin correlates to the M2 money supply, and whenever the Fed's balance sheet expands, it also expands the money supply. And all those things are really bad for Bitcoin, for big tech, for crypto, and anything that's growth oriented. Now, my thesis is that Kevin Warsh will not be able to do QT for much longer. Maybe they could do it for a few months, maybe 6 months in general, but he can't really do it for too long, and he might not even do QT at all. Now, you might say, why would you say that? Jerome Powell has been lowering the balance sheet since 2022, and nothing bad has happened, and everything is fine, and the market is much higher. So why can't Kevin Warsh do the same and continue doing QT? Well, the main reason nothing has happened in this period is due to the reverse repo pretty much being full of cash. And since then, the reverse repo has been drained to pretty much zero. And I'm going to let ChatGPT explain it to you. I could do better job than me. And it says when reverse repo is large, which is what we had over here, it acts as a cushion. It says QT can be funded partially by money market funds moving cash out of reverse repo into treasuries, which reduces reverse repo instead of draining bank reserves. This is what we did here. We didn't drain the bank reserves. We pretty much drained reverse repo. And reverse repo acts like a cushion on the market, cushion on the financial system. And that's why nothing major has happened. Okay, but when reverse repo is near zero, that substitution channel is mostly gone. So more of QT's impact hits bank reserves directly. And when bank reserves, they start to fall, you have less excess cash in the banking system, you have the credit spreads, they start to widen, you have a lot of things that could happen. I'm sure Kevin Warsh kind of knows that, but maybe a lot of market participants are not paying attention to that. And the market is pricing in a very hawkish Fed on QT, which is bad for risk assets, and it's good for companies that have a lot of cash flow in the near term, like Coca-Cola, Procter & Gamble, and a lot of those, you could say, defensive-related stocks. But I think once the market realizes that Kevin Warsh is not going to be as hawkish as all those people are expecting, we're going to have a massive, massive rotation, and it could happen during the second half of this year. Now, based on what I told you in terms of QT causing something bad to happen, there's a lot of indicators that are telling me that something bad could potentially happen systematically, maybe a bank failing, or maybe something else happening in the system. And this is an amazing indicator, which is the 10-year treasury minus the 3-month treasury. And every time it goes negative and it reinverts to positive territory, we have something bad happen. We had a major crash in 1990. We had a crash in 2000 once it went positive and it steepened up. We had the same thing before 2008. It even happened before COVID. And now it has happened again and it's starting to steepen up. And if I line it up with a potentially hawkish Fed on a reverse repo that's pretty much near zero, it could cause a lot of damage in the system. And if I line it up with the dollar being at record support, and if the dollar starts to rally from here like it did into the 2022 stock market crash and into previous pullbacks and crashes in general, I don't see how the stock market is going to be going up like crazy from here. So my personal thesis is that the best assets to be buying here is all those assets that are being sold off, things like Bitcoin, things like big tech, growth stocks in general, because the Fed, if they want to be hawkish, is not going to be able to be hawkish for too long because something systematically will likely happen. And even right now, we're having bad things happen within banks, private credit, and it's not even doing QT, Powell is doing QE. So again, I'm not seeing how that's going to happen. And once the market wakes up to it, we're going to have a major rotation. But in the meantime, between now and May, whenever Jerome Powell's term ends, I think we're still going to have downward pressure on the market. This is a basic technical chart, and I'm no expert, but I saw a double top back in January to April, and it was a decent sign that we could have a pullback, and that's very similar setup to what I saw back in January, February, and back then I bought some put options and raised a lot of cash, and I kind of did the same thing this time around. And if you look at this chart on a longer term basis, normally whenever we go down on S&P, or I should say on QQQ, we tend to somewhat retest the previous high. We almost retested the previous high in the 2022 market. We retested the previous high in the April pullback. So this time around, I would not be surprised if we have up to a 10% pullback left on QQQ and we retest or somewhat retest the previous high of about 540 on QQQ, which is pretty much the NASDAQ ETF. So I believe we likely have like maybe 5, 8, potentially up to 10% maximum to go before the rotations that I'm talking about happens. And I think it's going to be powerful and it's really going to be amazing. But there's a few more signs that I'm really looking for. And this is mainly whenever you look at previous markets, like let's say a market bottom. This is back in April. But if you look at any market bottom, normally in the last phase of a market bottom, all those assets like Coke and Verizon, all of them, they break down. All correlations go to 1 and everything breaks down together. And you see a really ugly chart. And whenever the market bottoms and it starts going up, everything pretty much rallies back together. I haven't seen a scenario like right now when Google is going up, but Microsoft is staying near their 52-week lows and people are calling for a bottom. If that was a bottom, I think Microsoft would be participating. I think a lot of the growth stocks, SoFi and others, would also be participating if we put up some kind of a bottom. So I'm going to tell you how I'm personally positioned for this in my portfolio. The first thing I did, which I did it a few days ago, is I bought a put option on QQQ, which is a NASDAQ ETF. And this is mainly a bet that if QQQ goes to 520, 530 by June of 2026, I get a 6x return on my money. So I put in 1% of my portfolio. If I'm right and we go down 10% by June, this 1% becomes 6%. Then I take the 6% and I use it as a cash position and I buy a lot of amazing stocks at a discount. But if I'm wrong, then I lose a percentage of that 1%, maybe 0.5% of my portfolio. So it doesn't really cost me a lot. I think this is a good hedge in general. But generally speaking, I'm starting to trim a lot of the stocks that I had, and they did really well on rotation. A lot of consumer staples. I talked about TPL. It's up 68% year to date. I'm going to start trimming TPL, and I'm going to be adding more to what people are hating, which is mainly Microsoft. I think it's one of the best bargains in this market with a wide moat. Insiders just purchased 2 million worth of stock. They haven't bought stock in 11 years. Massive net income margin, 22% earnings per share growth at 22 times earnings. So you're buying it at a 1 PEG ratio, and you have an amazing CEO that's actually running the company. So I'm buying a lot of what people are supposedly hating right now, like big tech, things within the growth stocks, although I'm not buying a lot of growth right now, mostly big tech and just growth-oriented stuff in general. I might even buy Bitcoin itself. We'll see what happens. But I think there's a massive misunderstanding by the market, believing that Kevin Walsh is going to be a permanent hawk, and we're not going to have a permanent hawk because the system itself doesn't allow it. There's too much debt. There's a lot of things that could go wrong, and reverse repo is drained to zero. So if they're doing QT right now, they're going to be draining from the bank reserves. And if that happens, a lot of banks could potentially fail. There's a lot of things within subprime auto lending that's not going too well, things within private credit. I don't think the administration or the Fed chairman himself wants that to happen. So once the market realizes it, I think we're going to have a powerful rotation from stocks that did really, really well into stocks like Microsoft and amazing growth-oriented stocks that will likely do well in the long term. But I think they can benefit from the rotation in the short term, and it could happen as soon as the second half of 2026. So that's my opinion on the market and what I'm doing. If you'd like to join me on what I'm buying, what I'm selling, I share everything I do in real time, and this is the link if you're interested. But thank you again. Hope you enjoyed it, and I'll talk to you in another video.